Well, we're ready to begin. Have this great seminar I've been looking to for a year. You've been visiting for a year. It's been terrific. Radek Paluszynski, I got your name right.
That's right, yeah.
And the title is The Ultralong Sovereign Default Risk. And you're going to tell us everything you need to know about that and more. Thank you very much.
So thank you very much for this opportunity to present to you, and thank you for coming. Thank you for connecting to the folks online. So public debt issuance and management is obviously a huge part of government economic policy. And in addition to managing levels of debt, dynamics of debt, there's also a long tradition of thinking about sovereign debt maturity in economics, the maturity structure. And there's a tremendous literature, both focusing on positive analyses of maturity structures of governments around the world, also normative prescriptions. What should government do in terms of its debt maturity? So this paper analyzes a recent emergence, or perhaps a re-emergence of old new instruments, which have been popularly called the ultra-long bonds, and hence I kind of inherit this term. Ultra-long bonds, my working definition, are going to be bonds with longer maturity than the longest maturity bond that the US government issues, which is about 30.5 years. So for many decades following World War II, that was the longest maturity sovereign bond that you would see in financial markets. And only over the last 25 years or so, we have observed an emergence of bonds with maturity much longer than that, ranging actually up to 100 years. I say it's an old new instrument because actually a century ago, it used to be norm for some of the advanced governments at the time to manage their public debts in the form of consols. So basically bonds that do not have a specific maturity date. And actually the UK government repaid the last one of those bonds only in 2014. But in a way, the world has changed tremendously since then, and we've had many decades without such instruments, so I kind of treat it as an emergence of something new. And the phenomenon has been...
These are flat, nominal bonds, too, right?
That's right.
So in real terms, which is the natural way, the appropriate way to think of it, you're really talking about a wedge that goes down to typical rates of inflation. After 30 years of 2% inflation, there's not much of the bond left.
Mm-hmm. Absolutely, yes. So
is that, are you measuring the duration of the bond in real terms?
Yeah, so the duration obviously is much shorter than, for example, 100. It's, in my quantitative analysis of the model, I'll try to hit exactly kind of the average duration of these bonds, taking into account the real claims that they offer. Right? But it's still much beyond what has been the norm, and especially what is the norm for the US.
Great point. So Queen Victoria issued consols, but under the gold standard. So they were like index perpetuities. Well, if we're going to have 2% inflation target, if we want nominal bonds, why don't they just coupons rise 2% a year?
Yeah, exactly.
That would make abundant sense.
Be indexed.
Well, we have indexed at small amounts of it, yes.
That's a good point. So this new instrument has still been somewhat niche, but far from trivial. There's a wide range of countries that have issued such bonds, from countries like Mexico, Argentina, Peru, to countries like Japan, UK, Switzerland. So basically the question I approached, they asked myself and tried to answer, is why issue such securities, and especially why recently, why right now? And as with all hard problems in economics, there are many avenues and many factors that contribute to an emergence of something new. My focus here, which is coming from my original research interests, but also something that I think caught attention of financial market commentators the most is the role of default risk and these countries issuing such bonds, which are typically considered frequent defaulters. So for example, here's a quote from The Economist commenting on Mexico issuing several batches of 100-year bonds, arguing that, or perhaps conjecturing that foreign creditors are very bullish. These are extraordinarily good terms given Mexico's distinctly spotty credit record. So kind of the reception was that perhaps the sign that Mexico is now able to easily issue 100-year bonds is also a sign that investors have better faith in Mexico's credit records than in the past.
So if you issue short-term debt, you got to roll it over.
That's right.
So it's not obvious that from a bond investor point of view, you're better off with short-term debt rather than long-term debt. So they get in trouble. It's a rollover crisis. You're done.
Precisely.
Whereas
So
if you have a long bond, they get in a crisis. Okay, they stop paying interest for a while. You hash it out. You agree. Maybe we'll get our interest back later. But you're not. The rollover crisis actually could make short-term debt more risky than. I mean, you either get paid off or you take a huge haircut and it's done. There's no extend and pretend going.
So pretty much John just summarized most of the gist of the paper here.
Sorry. It's just what happens when you don't read the
Maybe we can just call it the day. But absolutely. So there is a hard trade-off involved there, and I'm going to try to highlight it and kind of quantify the solution to this trade-off. I'm just kind of providing the feel of the markets at the time. I think most commentators were genuinely puzzled that.
Now, regarding Mexico, didn't we bail them out?
In '95, that's right.
Yeah, so who we bailed out by the American banks that bought some of these, but
With the IMF, that's right.
yeah, we bailed them out. Now, perhaps the market is thinking that could happen again.
Absolutely, but even beyond that bailout, in the 100 years prior to 2015, Mexico had 3 external defaults. So that would have been a near fourth. So
The
a near
bailouts
miss on the
kind of
fourth.
go the other way. So I know the Greek bailout in detail. And the Greek bailout, since they sat around, the ECB came in, all the short-term guys who were rolling over, they got out. And it was actually long-term bondholders this time who eventually took the haircuts.
I don't know what the details are. I just know we bailed them out, and I think we even made money on
That's right.
it. I don't think the Germans made money on the Greek bailout.
But yeah, I mean, that's the most recent episode when Mexico dodged the bullet. So that may also have been part of the calculus. So in a summary of this paper is that I'm going to show you some evidence on the issuance of these ultra-long bonds over time and interest rates. And then because this is such a new phenomenon and very limited data, there isn't much to do with formal empirical analysis. So I'm going to resort to building a model with endogenous maturity, endogenous sovereign default, and crucially variable risk-free interest rate. And so some results that I'll try to convince you of emerging from this model is that these ultra-long bonds are useful to hedge against low-frequency movements in the risk-free interest rate. So it's precisely the insurance story. And the benefit of this insurance is largest when the interest rate is persistent, very persistent as it is in the data, and low. I'll have this model calibrated to Mexico's default history. So basically a country that defaults 3 times per century, and show you that they roughly capture the recent ultra-long issuances and the corresponding spreads. Not bad. And kind of big part of the story is that this default risk precisely helps to motivate the hedging when the rates are low. So it's not really that the default risk is an inhibitor to issuing such debt for the government, but actually the presence of default risk makes the government even more motivated to buy some more insurance. So before I jump in, maybe I can just summarize or try to convey intuition for the main mechanism of hedging versus incentive in my model. So this is going to be a trade-off between the hedging benefit of long-term debt and incentive benefits of short-term debt. So if you think about an impatient borrower, like most governments who accumulate large debts, we think of them as impatient. The long-term debt in general insulates such borrowers from shocks to risk-free interest rates. So if you have an impatient borrower, observes that the interest rate is very low today and expects it to go up in the future, then this increase in the risk-free interest rate will be the bad news. It will make the impatient borrower suffer. But at the same time, a rise in this interest rate will reduces bond prices and reduces the present value of outstanding debt obligations. So in that sense, it insulates the borrower from shocks to this risk-free rate. And precisely when the risk-free rate is very persistent, the benefit of the hedging from something like an ultra-long debt is the largest. So that's the upside, but there's obviously a downside of issuing such an instrument because it has these negatives incentives to default properties. So precisely the fact that the borrower is insured against these shocks in the future makes them less willing to keep the debt in check and attain better rollover conditions, better bond prices. So that ends up increasing the future default risk. It comes from the lack of commitment of the government. And the investors know it today that in the future, their bonds will be diluted. And
why you've issued long-term debt versus short-term debt? Why do you have more incentive to default given long-term debt?
Because tomorrow you will wake up and you precisely don't have to worry about shocks and keeping your overall indebtedness in checks because you basically you're insured, right? So the rollover of the debt is less painful, and as a result, if you're impatient, you can actually increase your overall borrowing. So that's the debt dilution channel. So that comes from lack of commitment of the government. Today, the government issues long-term debt and would like to promise investors that in the future it will keep fiscal discipline and keep prices of this debt high.
Is this about risk?
It's about default,
or is it about just because default is default? If I promise to pay back, they're rolling over short-term debt. It doesn't that. I mean, if we're on the same interest rate path, whether I default on my long-term debt or short-term debt, it's the same default. I don't see why there's a difference. You said something about if there's an interest rate shock. It's not obvious to me why after an interest rate shock, in fact, I would think it goes the other way. Interest rates go up and I have short-term debt. Oh my God, now I got to pay more on this short-term debt. Let's default.
That's right. So you will reduce your overall indebtedness to still roll over the debt at high prices, right? You don't want to roll over the debt at interest rates of 10 or 15%. But especially if all of your debt was in the form of perpetuities, then you can just sleep tight. You don't have to worry about keeping your fiscal policy in check for the investors, and as a result, investors are diluted.
There's a bunch of Diamond and Rajan stuff about how
it's it's
sort of the threat of
the same logic, but for sovereigns.
Threat versus people to be okay.
Yeah. So at the end of the day, there is a solution to this trade-off between the positive hedging feature of long-term debt and negative incentives feature of long-term debt, and I'll show you the solution to this. What I'm not going to talk about, but are also important forces, is the demand structure and potential clientele effects. So this is not your everyday market. The buyers of these ultra-long bonds have been concentrated among pension funds, life insurance companies, who have preference for specific maturities. And that is also a big driver of these decisions for the governments to offer bonds at these specific maturities.
That's the point. I think it was early 2000s when the UK said pension funds, you got to buy long-term government bonds, and long-term government bond yields just go boom.
That's right, because
it wasn't really preference, it's regulation.
Regulation. So often these types of institutions face regulatory duration mismatch. So basically, they have liabilities spanning decades into the future, and the regulation requires them to kind of match it up with some cash flows from assets. So they have demand for these types of
So
assets.
do you think that you had a trade-off between two forces? Did something change to make one of those more salient than the other one? Why the change in the demand issue?
I mean, so in a way, the change, which I'll highlight, but I think works also for this force, is this trend in the risk-free interest rate around the world.
Okay.
The decline in the risk-free interest rate around the world also makes the regulation more kind of binding for these types of investors.
So the external force is the decline in the risk-free rate,
That's right,
and that's going to change this trade-off with incentives. that you're
precisely.
making. But you're not looking at the decline in the term premium.
No,
'Cause
I mean,
the other sort of obvious one is governments look at, like European governments, 10-year bonds, negative yields. Yeah, here, yeah.
yeah, but actually, I have a backup slide on this. Maybe I can show it to you in just a moment. I'm also going to restrict my attention to countries that are small and do not control or do not make decisions about the currency in which these bonds are issued. So I'm not going to focus on incentives to default by inflation or some kind of sovereign market power. I'm also not going to talk about the role of debt maturity in providing commitment to the timing of taxes. That it's a separate literature that goes back to Lucas and Stoke. Okay, so let me start with showing you some evidence. So this is new issuance of ultra-long bonds. So again, ultra-long bonds are any bonds with maturity higher than 30.5 years, which is the longest maturity bond that the US government ever issued. So this is just a simple sum of real amounts. And so you can see how there are some blips in late 80s, also late 90s. And then really this market kind of gets started in starting from 2000. And then these issuances come in some kind of waves. So the central kind of a relationship that I'm looking in this paper at is the relationship between these new issuances of the ultra-long debt and this real interest rate, the risk-free interest rate, which is just assumed to be the US one. So we've had a declining trend of this real risk-free interest rate since the beginning of the 80s. And so at some point, it seems like when it fell to a level low enough, the whole market kind of got started. So that would be kind of a change in the extensive margin. And then also, if you look at, specifically the period post-2000, also these waves of issuances are correlated with these kind of local cycles of the real risk-free interest rate. So not surprisingly, the correlation between the two is actually very negative. So precisely when this real rate dips, that's when we observe a whole new wave.
Now, this is all common sense. However, the US didn't participate in this kind of shift.
That's right. It did not.
Didn't we go to shortening at times the
That's right.
structure? Which,
Yeah.
is there any explanation for why that was the case?
So I certainly know that there were discussions at the Treasury about potentially issuing a 50-year bond. It didn't go anywhere. I talked to Darrell Duffy about it, and he is a fan of or proponent of the clientele effects story, and simply he argues that there are no specific demands for these kind of bonds for the US. But obviously US is for US it's a much deeper issue than for countries like Mexico.
Wall Street was against.
Right.
Yeah. Reasons. Unclear.
Yeah. When Mexico or Austria, say, issues a bond like this, probably you can assume that that nothing in aggregate changes for the market. If the US issues a brand new bond in high amounts, that has the power to influence the whole market. So
Well, the US share of debt in the world is large. I mean, it's like 10-15%. I think if you did a Herfindahl index, it wouldn't be that big. It wouldn't be on the level that we would invoke antitrust policy if this was a.
So, but still, so I'm not gonna look at the countries that are own currency issuers, but you know, some of the ones that did issue, like UK, Switzerland, Japan, they were still. It's clear they were kind of cautious about this, right? So none of them went to maturities beyond 50 years, and still they kept the amount of such debt.
What did Austria issue there?
Austria issued a 100-year in addition to a 70-year bond.
But in what currency?
In euro.
Euro.
But I'm assuming that Austria is small enough that it's not really a.
What about Mexico?
Mexico issued in a range of currencies: euro, dollar, British pound. So this is just to give you a sense of pricing. So this is a snapshot of euro-denominated yield curves for Mexico and for Austria, which I take here as some kind of a risk-free benchmark. So you can see. So I think this is a snapshot in 2019, shortly after Austria issued its own 100-year bond. So you can see that well, both the yield curves are increasing, and also the spread curve, which is the difference between them, is increasing, and so we have the spread at the 100-year of about 2.5 percentage points. If we plot it over time, it's actually pretty stable between 2.5 and 3 percentage points. Obviously, in periods of stress like in COVID or when the U.S. interest rates are rising, it goes up, but then it falls back down. So this is, as a comparison, this is the Mexico to U.S. 10-year spread. So overall, the pricing of these bonds is fairly stable, and there's some endogenous spread term premium that is also going to feature. Okay, so unless there are some other questions, I'm going to describe my model to try to think about this phenomenon. So it will be a model of small open economy government with endogenous default. It kind of follows the steps of a large literature that has developed over the past 15 years or so, going back to Ariano, Chatterjee, Eigengor, I'm sorry, with some additional new elements, which I highlight here in bold fonts. So I'll have a stochastic process for income, but also for a risk-free interest rate, which is typically assumed to be a parameter. I'm assuming that government acts on behalf of households to smooth out and front-load consumption. So that is useful to smooth out shocks, effects of shocks to consumption, but also the government is impatient, so it accumulates large amount of debt. Two types of defaultable debt, one with shorter, one with longer maturity. And in the case of default, there are two punishments: direct cost to income, which is typically needed to generate large amount of debt in equilibrium, and temporary exclusion from credit markets. I'm going to assume a zero recovery rate for debt following a settlement on default. And I'm also going to assume that international lenders are perfectly competitive and risk neutrals. These two assumptions, I have an extension where I relax both of them. And in a way, they complicate a lot and they offset each other out to some extent. So in this version, I don't have them.
Now, there's obviously more than two types of debt. Because if somebody issues a 30-year bond, then tomorrow next year becomes a 29-year bond, next year 28-year bond.
Absolutely. So let me talk about this.
So
let me talk about this. So this is a big or an issue in modeling debt maturity.
Yeah.
In that if we were to take it literally,
Yeah.
then we would have an enormous state space,
Yes.
simply because we would have to keep track of the amount of debt outstanding at every possible maturity. So that would be not a tractable problem.
A paper of mine with Felix Kugel and Carl Schmetters did that.
Okay, I'll take a look at this after talk.
Well, I call it tracking.
You got a bigger computer.
Yeah.
Actually,
Yeah,
what
I mean, at Houston, we have less computing power than Stanford.
PC and fairly.
I'm just joking.
Quick.
No, we can handle 30-dimensional state spaces if we want to be.
Come on, 900.
To make this somewhat, let's say, more or tractable for everyday users, the typical modeling approach is to assume that bonds are perpetuities with declining coupon payments over time. So you issue an amount of bond and it has some decay parameter, delta. And so, for example, here's just an illustration. If this delta is equal to 1, then it's a 1-period debt. Tomorrow you have to repay it, and the outstanding amount is 0 forever. On the other hand, if it's an actual perpetuity, then delta is equal to 0, and the maturity date never comes. You just keep rolling it over until you may buy it back one day. And then for some delta in between, like here, for example, 0.33, this is the profile of outstanding amounts over time. So we typically choose this delta to kind of approximate the average debt maturity across different terms. So in the literature so far, there have been some papers that modeled endogenous debt maturity by choosing amounts of 2 bonds. And these would be one short-term, one period debt. So like the black line over here, and one generic long-term debt that will approximate for the whole stock of long-term debt. That will be like this red line. In my paper here, I'm going to have also 2, but I'm going to treat this something like this red line as my shorter term debt. And I'm going to have something that looks like this blue, but not exactly, because I want to fit the duration as mentioned at the beginning, but something close to this blue line. So that's going to be the market structure. So we have stochastic processes and it's an endowment economy. So log income is just the sum of realized growth rates of income. And this crucial new thing is the AR1 process for the risk-free interest rates rather than it being a parameter.
So the interest rate and the growth rate have nothing to do with each other?
No, I don't assume any relation, but obviously I could. There is a relationship, but
R equals delta plus gamma G is the state, the consumer's first order condition tends to link those. I guess you're thinking about the income growth of a small country.
small country, that's right.
And the interest rate is being international. So
Yeah,
that would be
yeah.
like,
Yeah. So the aggregate states are the outstanding amount of this generic long-term debt B, the outstanding amount of ultra-long debt BU, and the vector of the stochastic states, which is the previous level income, previous period income level, which actually after detrending it drops out, and then growth rate of income and the level of the risk-free interest rate. In every period, the government chooses whether to repay or default by comparing the values associated with these 2 actions. In the case of repayment, it chooses the level of consumption and the new amounts of the two bonds, where the budget constraint is such that consumption is equal to income minus the repayment of the 2 types of debt. I'm assuming here that the coupon on this regular maturity debt is equal to 1, so the coupon is basically the government just repays the full B, whereas the coupon on the ultra-long debt is some number kappa. So the government repays the maturing fraction delta U, and on the unmatured portion of that bond, it pays the coupon, and then it issues new debt net of what's outstanding, what rolls over into the next period, and it gets these endogenous prices, Q and QU. In the case of default, there's some linear loss of a fraction of income, and then the government is excluded for a stochastic number of periods where In each period, it has a probability theta of re-entering, and if it's readmitted to the markets, it kind of starts over with zero debt, starts accumulating. If it's not readmitted, then it continues in default.
So the consumers here, the people, they have no assets, they just basically eat whatever.
That's right. It's like the only decision basically the government makes decision on behalf of households.
They
For
have
the-
no
for-
independent savings or assets or.
Yeah, I mean, because we are thinking here about external debt, right? So it's like the government manages this external debt. There could be also domestic debt.
Yeah, but don't some Mexicans own some of this debt that's issued by the government?
They issue the domestic debt. So for the ultralong bonds for Mexico, it's pretty much all of it is owned by foreign residents. So that's why it's kind of, it simplifies. It's also all in foreign currency.
So yeah, it is, your function of debt here is to smooth consumption, and exports and imports are your only way of effectively.
That's right.
So the government manages that.
That's
As opposed to the vision of government debt, say the Barrel or a Judd vision of government debt, where what you're doing is you have tax receipts. You want to smooth the tax rate and you have temporary spending needs. I don't know if it would make a difference, but they're two very different objectives.
So in a way, here we abstract from taxing domestic citizens and issuing debt to them.
Now, your autarky punishment, that means that there's no, not only autarky in finance markets, but also it's also autarky in the goods markets also.
Absolutely. So, I mean,
Is
it
that
is
what happens with
it is-
countries when they default?
it is kind of a skeleton in this literature, in the sense that, yes, we observe that sovereign defaults are associated with steep contractions in real economy. So that's the fact.
Yes, yes.
But obviously the causality of this is
Yeah, but is it because
whether it's the contraction happens because government defaulted, or whether the government defaulted because it's in the middle of a
as a
severe
matter
recession?
of actual fact, does international trade die?
Yes.
Yes.
It's forbidden, or it just dies because of other economic reasons?
It's not forbidden, but the government has no access to financing of such trade. So I mean, for private citizens can potentially still trade with abroad, but for example, Argentina was essentially excluded from financial markets for 20 years.
Yeah, financial market, but the goods market.
I mean, we observed that it's also kind of collapses.
Finance imports, you got to export some capital, and nobody wants your capital. You can't finance imports. So certainly Greece, East
The thing is
Asia.
that some Mexicans have dollar assets, like
Right.
in American banks. So it's, and I presume some Argentinians also had dollar assets in American banks or Swiss banks. So the assumption here is that the only holder of assets is the government.
But on that, to finance a trade
Yeah.
deficit, you got to get people to hold more of your assets, and nobody wants them.
Yeah, I mean, I agree with you. It's not a perfect
Yeah.
assumption. I mean, there's definitely some trade that keeps going, simply because private residents can do it
Yeah,
if they have the funds. But I mean, we do observe that it's pretty much collapses following periods like this, following events like this.
I know that the cocaine trade collapses.
Or maybe just, yeah, it changes form. Okay, so the other part of, or kind of to close the model is, we got to specify these bond prices, which are endogenous. So the price of a regular maturity bond is a discounted expected cash flow from the repayment in the event that the government repays. So one minus this policy function to whether to default or not. And in the case of default, there's a repayment of coupon here, which is normalized to 1. And then investors continue to hold 1 minus delta fraction of this debt that has the new value of Q that depends on the equilibrium policy functions of the government next period. So these B double primes are equilibrium objects. And so similarly for ultra-long, and this is precisely where these problems with incentives come from. Today, the government would like to sell long-term debt and would like to promise that come next period, these B double primes will actually be not too high, will be kept in check so that the investors can enjoy a high bond price. But there's lack of commitment, and when the government wakes up next period, it will have incentive to increase debt if it has the capacity to do so. And the investors foresee this debt dilution problem and already reduce the bond prices today. So that's the issue. So here's some more specific intuition why issue long-term debt at all. So here's like a stylized Euler equation for the choice of debt level with a generic decay rate delta I. In reality, this problem is non-differentiable, so it's not solved by actually calculating this Euler equation, but we can just for the sake of illustration we can write it down. So the left-hand side shows the marginal benefit of issuing an extra unit of debt. Well, the marginal benefit is that you can increase consumption and you enjoy some marginal utility of consumption. How much will you get in terms of revenue? Well, you will get the price of that bond, but also you have to take into account that an extra unit of debt reduces bond prices across the board, both of that bond, but also of the other bond. And in that way, you reduce the revenue that you get from the issuance of all other outstanding units of not only this particular bond, but also the other bond. So in a way, there's like a Laffer curve for the revenue from debt issuance. And that, in equilibrium where the trade-off is resolved, that is equal to the marginal cost of issuing this unit of debt, which is the repayment of it tomorrow. So that's the repayment of coupon and tomorrow's value of that debt, the price, times the marginal utility of consumption tomorrow. And so here as an illustration, we can use the properties of covariance to actually rewrite this expectation of the product of two random variables as the sum of the product of expectations and the covariance between these two.
Where did default tomorrow disappear here? I mean, if I borrow more today, that might induce me to default more tomorrow. I know.
That's right. So that's kind of we're assuming that at this marginal unit here, there's no default decision, but it does feature in the shape of these bond price functions.
Yeah, that I can see that.
Yeah.
As you get more likely to default, those are going to get
But precisely because this default is a discrete decision and generates a kink in the value function, we wouldn't be able to, in general, write down this Euler equation. So this is more for illustration.
Okay, so there's a max on the right-hand side here.
Right. So basically, if to the extent that this covariance between marginal utility of consumption tomorrow and the bond price tomorrow is a negative term and large in absolute value, the government is able to, in a way, reduce the marginal cost of issuing debt. And so in general, this covariance is negative, but precisely for debt with longer maturity, simply the volatility in these bond prices tomorrow is much higher, and this covariance term is potentially larger in absolute terms. But obviously, longer term maturity also has a more severe debt dilution problem, and so these partial derivatives are also more negative. So in a way, this the revenue from issuance declines faster. And so there is some solution to this trade-off. And it's already been kind of shown in previous literature for hedging shocks to income, let's say. But so my point here is that when you have a source of risk like the risk-free interest rate, especially that feature these low frequency movements, then you really need the ultra-long debt to hedge against them, but also ultra-long debt reduces incentives to repay faster. So to quantify the model, I estimate the parameters of these stochastic processes for the growth rate and for the risk-free interest rate. I conduct.
Where do you get data for that? Where's the data for that come from?
So this is my quantification is specifically for Mexico.
Okay.
So these growth rates are just it's just growth rates for Mexico's GDP since 1980. And for the risk-free equation, so Cleveland Fed actually provides estimates of the risk-free interest rate for the US starting from 1982 that incorporates data on inflation expectations and risk premium to have kind of longer series in order to be able to capture this level of unconditional mean of the risk-free interest rate that actually ended with data from 1955 where I calculate risk-free interest rate as just interest rate net of the currently observed inflation rate. That kind of assumes that inflation is a random walk or people have adaptive expectations.
So we have this trend in the interest rate in the data.
There is, so but actually, so this trend is part of my AR1 process, right? So I have
we get some shocks that look like a trend.
Right. Exactly. So in the unconditional mean is just above 2%. In early 1980s, the realization was 6, 7, 8, and people were expecting it to mean revert. More recently, the realization was even -1, and people were expecting it to mean revert upwards. So that's kind of important part of the story.
Did you test the hypothesis that there was a trend? You're assuming here that there is, R bar is like the long run target.
Right.
Whereas the data indicates that there's kind of a downhill slope to it. Now that's
that's why
AR2 or specification.
So that's why if I only used data from 1982, then yeah.
But in terms of the U.S. long run risk-free interest rate, it certainly go back. Well, there's 55.
That's right. So if you start from 55, it kind of looks like a trend that is stationary. So I did test for stationarity.
I remember, I don't know, a year ago or so, we had a seminar, I think in this presentation, I think in this seminar, somebody had a study of long run interest.
That's right. I've seen that since like 14th century.
Yeah, and that there seems to be
right.
A long run trend there.
I would also add, we're trying to understand the behavior of people. And a lot of people in a lot of treasuries thought this was a trend that was going to go down forever. So it's easy enough for you to say, okay, well, what happens if we throw a downward trend, and that's what people's expectations are, solve the model that way. It's going to go.
But there are also discussions among economists arguing that it actually will revert upwards due to demographic change, automation.
All of the Blanchard and Summers and company thought this was down
forever.
If it's just an interest.
If I were to assume that it's down forever, then this story would not work really.
Okay, well that's
so. So the remaining parameters I calibrate using some external data and internal calibration to hit basic 2 moments: the average debt holding and probability of default, which is 3 defaults per century, kind of like how Mexico would behave.
Before you didn't say a word about how you solve this model, which looks kind of hard to me, not to Kennedy. So you got a value function for the individual that includes the equilibrium bond price function.
That's right.
Then you got a bond price function that depends on how the individual.
That's right. It's in general a hard problem. So I iterate jointly on the continuation value of the government and both bond prices. And I update
so you're solving a fixed point inside a value function iteration.
So that's one way to solve it. I actually solve kind of jointly for a joint fixed point of the continuation value and bond prices. So it's like a one loop iteration. There are different ways to do this. I actually have one solution where I approximate or I evaluate off-grid points using cubic splines. so basically a very precise interpolation is needed to get this exact. The more recent approach, which I also adopted more recently, is to assume there is a tiny shock in the decision of the government. So basically a trembling hand of some sort, following the IO literature going back to McFadden, where you basically assume that the government has a distribution of potential choices, which are very concentrated around some level of debt, but there is a possibility for noise in their decision. Once you assume that and assume that these noise shocks are distributed according to extreme value distribution, then you can get nice closed form solutions for this, and that
You can,
facilitates
you get closed form solutions for the problem in the discrete.
with respect to this discrete choice. That's right.
Yeah.
And
Not-
that-
You
but
don't get
that-
closed form solutions for your whole problem.
No, absolutely not. You still have to do value function iteration, but that just allows for this joint problem of the government's value and these bond prices to converge much easier. Smooth out the default.
Yeah.
Yes, the default is discrete, but you add a little bit of noise. That
Now, your more fundamental problem is that when you have the max operator there, the value today is a max of a couple things. You have non-concavities popping in. So even the smoothing out the kinks, you still have a non-concave value function.
That's right.
And that creates problems.
Yeah, so there are some non-monotonicities
Yes.
in objects that should be monotonic.
Well,
Popping up.
no, I mean, they should be. They aren't monotonic.
In theory. In practice, yeah, they are not monotonic. That's right.
But the theorem says that the iteration converges.
Oh, yeah, you need shape preservation, all sorts of things for the theory to apply.
So here are some more illustrations just for intuition. Here are equilibrium bond prices. So this is what bond price you get for an amount of regular maturity debt that you choose and ultra long maturity debt that you choose. So these bond prices have a fairly standard shape in the sense that they are declining with more debt that you take on. Initially, they're declining mildly, and then at some point there's some cliff. And beyond that cliff, the probability of default skyrockets, and these bond prices plunge. So because the government is impatient, it typically oscillates somewhere around this cliff, a little bit away, and once in a while, a big enough shock pushes them off the cliff, and that's when these 3 defaults per century occur. And so you can notice that for the ultra-long bonds, their level overall is lower, and they are kind of more steep for lower levels of debt and less steep for higher. That's simply because the ultra-long bonds take into account a much longer path of events in the future. So even if today's immediate default probability is high, they incorporate the periods of mean reversion when it's going to be lower, and vice versa. Now, crucially for my story here is that obviously these bond prices vary with the risk-free interest rate, which is a shock in my model. And for some regular long-term debt, it varies somewhat, but much less than for ultra-long bonds, right? Ultra-long bonds take into account a much longer path of these risk-free interest rates and vary. When the risk-free interest rate changes, basically, the ultra-long bond price changes by a lot more than the regular maturity. And so this extra volatility in ultra-long bonds is precisely why it's a good hedge against risk-free interest rates. So regular maturity bond theoretically also hedges a little bit against these kind of shocks, but quantitatively much less than ultra-long. And one period debt would not hedge against risk-free interest rates shocks at all. So that's kind of intuition for the hedging itself. And then the question is, so why recently, when these interest rates were low, why do we observe such a rush to hedge, basically, to issue such debt, especially among defaulting countries? So this is basically think about millions of simulations of default and non-default decision binary. And this is plotted against the growth shock realization on the y-axis and change in interest rate on the x-axis. So quite intuitively, if the growth shock that you get is high, you don't default. These are the yellow dots. If it's low, you tend to default, right? So there's some endogenous default thresholds in between, which is kind of fuzzy in this picture because these are just simulations. And crucially, this endogenous default threshold varies with what's going on currently with the risk-free interest rate. So if the risk-free interest rate just goes down, then you may still repay even if you're in the middle of a 5% recession. If it actually goes up, then you may default even if the recession is only 2.5%. So this is kind of why when interest rate is kind of at the bottom of the cycle and you expect it to mean revert, right? You're looking into the future that looks more like the right-hand side of this picture than the left-hand side of this picture. And your demand for hedging is higher to ensure against these potential events. So when I do just the simulation of the ergodic distribution, I find the overall share of these ultra-long bonds of about 6%, which is kind of in the middle of the range of what these countries issued, somewhere between 1 and 10. For Mexico, it's about 5%. And the spreads on both types of bonds are about 3%, which reflects here the default probability that was a targeted moment, simply because the investors are risk neutral. Now, crucially, when I look at correlation, these shares, both the share of overall outstanding ultra-long debt and the share of newly issued ultra-long debt correlates negatively with this risk-free interest rate. So that's why lower risk-free interest rate is when we expect in this model to see more issuance of these ultra-long bonds. Here are some more statistics to kind of dig deeper into the determinants of the hedging. If you remember, I mentioned to you that this correlation or covariance between marginal utility of consumption and the bond price is kind of crucial for the hedging. And so here it shows that this correlation for the ultra-long bonds is precisely more negative when risk-free interest rate is below unconditional mean than when it's above. And so as a result, we get larger outstanding amounts of ultra-long bonds and new issuance of ultra-long bonds when it's below the mean than above the mean. Now, obviously here, even when the hedging motive is there always, right? Even if interest rate is at the peak of the cycle. So my model really doesn't explain why we didn't see issuance of such bonds, let's say in early 1980s, because the prediction would be that the government would still issue some over there. But critically, there is this negative correlation. I consider some alternative calibrations of this model, and so most prominently.
The other thing that's happened is the quantity of government debt has gone up tremendously.
That's right.
Which a straight consumption smoothing, I'm not sure that will get. I mean, our government is
right. This model will also.
About what happened? Why did they issue long-term debt in the 1980s? Because debt to GDP ratio was 25%, and half of that was cash. So why bother?
Right, that's a good point. So in this model, I won't have it. Right, there's an ergodic distribution where the government picks this debt to GDP level and kind of oscillates around this. Now there are some.
A time of low interest rates would be a time to issue a lot of debt and go on to consumption, wouldn't it?
That's right.
So you might.
The government is impatient, yeah. So that's
one of the things that senses intuitively is that interest rates got really low. Government said, "Great, let's borrow and go buy Mercedes."
That's right. So overall,
you might have that act.
Yeah. So overall, debt went up, but within this increasing debt issuance, fraction of the very long-term debt, first of all, emerged for these ultra-long bonds, and then went up.
It's a natural question to ask of your model. Do you capture the rise in government debt along with the declining interest rate as well as the change in maturity structure?
Right. To some extent, I do. Simply because when interest rate is very high in my model, the debt to GDP will be much lower than the
Right.
This unconditional mean. Now, I won't be able to capture the magnitude of the increase that we observed in the world.
No,
I think that's a question.
depends on your elasticity of intertemporal substitution.
That's right. It's 1/2 over here, so it's not going to allow for the kind of magnitude of the increase in debt that we've observed. Although I have a previous paper where I kind of get that by having a regime switching in the parameters of the government. So if we admit that there is some regime switch that occurred somewhere along the way, perhaps with higher impatience playing the role, then that could be explained.
Explaining a trend with regime switching is kind of cheating.
Yeah, it's not the. I mean, in general, we don't really have great theories for why governments carry around so much debt. I would say, at least quantitatively. So
if markets are willing to lend to you at -2%, go borrow like crazy.
Right. So I consider some alternative calibrations. So one of them is an economy that has higher debt. I just picked 50% higher debt to GDP, and also 50% lower default probability. So that would be proxying for example, the small European countries that also issued ultra-long bonds like Austria, Belgium, Ireland. And so interestingly, I also find them to have this hedging motive and to issue some fraction of their debt in the form of ultra-long bonds. But this correlation is still negative, but much weaker. So really, this it seems like this default risk is important to drive this negative correlation. I also consider a variance of the model where either risk-free interest rate is a parameter, a constant, or just IID, and I observed just negligible amounts of this ultra-long bonds in equilibrium. So it's really about high persistence in R that is needed to generate realistic levels. Okay, so in the last few minutes, maybe I just have 2 exercises to kind of answer. So what, right? So what are the implications from having this new instrument? So here I just compare my baseline economy with ultra-long bonds to an economy with the same parameters, but I just shut down the possibility of access to this instrument. You can only use your generic long-term debt. And so what I observe is the frequency of defaults goes up a little bit, and as a result, debt to GDP goes down. The volatility of consumption relative to income, the volatility of trade balance goes mildly up. Overall, there is a small consumption loss, and in terms of consumption equivalent units, there's a utility loss of about 0.4% of consumption. So it's not a big number, but it's also not negligible. And yeah, I mean, having access to an extra insurance allows you to avert some defaults that you wouldn't have avoided without it. It affords you a bit less volatility thanks to the insurance property. And so finally, we can actually see what the model predicts for Mexico, literally, right? So I can pick the path of Mexican growth rates, growth shocks, and the path of interest rate shocks, and see the predictions for the model for these paths. And so here, I start in 1999, and so kind of, my model. In my model, the government issues the biggest chunk of the ultra-long bonds sooner than in reality. So already in 2001, I think. But then crucially, there are these two more waves in early 2010s and then right after COVID, where real interest rate drops to the lowest, actually negative values, and we still have these waves of issuance. So if I were to plot the data, it would be, you would see these exact two spikes, they would just be higher. So simple explanation for this is that, perhaps there's some transaction costs to organize the issuance of such a new security, and it took some time before.
I mean, both COVID and 2008, the growth in the interest rate did have something to do with each other. Mexico and the US had catastrophically low growth.
That's right.
The interest rate went down. They weren't.
That's right. So, I mean, it's not on this picture, but these growth rates are fed in exactly.
Okay, so you don't, even though it's not in the stochastic process, you do feed in the simulation.
I feed in the exact.
Coincidentally.
Yeah.
Okay, that's.
So in a way, these drops in the risk-free interest rate also allowed the government to avoid default in this case, with something like during COVID, it's a 9% decline in income. And this model would have certainly defaulted if it wasn't for this drop in the risk-free interest rate. Anyway, so I get these two spikes, although in a lower magnitude. I also kind of get the pattern of the spreads, although also the magnitudes here are off. So the ultra-long bonds command some spread term premium over regular maturity bonds. It's about 1 percentage point in the data. For me, it's much less. But crucially, in the times of stress, it actually reverts. So, for example, here's COVID, and the picture I showed you at the beginning also had this near reversal of the spread term premium in 2020. And then the bottom two panels just show you that with ultra-long debt available, the government is able to have higher debt to GDP, and consumption is less. You can kind of see this lower volatility. The blue one is without access to ultra-long bonds, and it's kind of the standard deviation of this consumption is higher than with. So it points to simply the hedging property of this instrument. So
other countries.
So in my model, this is just the calibration to Mexico. I mean, I have this one additional calibration for some generic, what I would call a small European country, but actually I didn't do the path, so that would be interesting. But yeah, the model is, I think Mexico is kind of the most interesting and also a robust case of an ultra-long debt issuer among emerging countries. So that was my kind of original focus here. So ultra-long sovereign debt is kind of an old but new instrument in financial markets. And I'm proposing here a model of a government choosing to issue such bonds. And the key to this decision is the motive to hedge against low frequency movements in interest rates. The model can rationalize these recent issuances and actually default risk rather than preventing Mexican government from selling 100-year bonds is actually something that motivates it due to this elevated hedging motive, precisely when rates are low.
What about the US?
Yeah, I would view, I think other than my paper, there's one PhD thesis about this recent emergence of ultra-long bonds just from empirical point of view. So in a way, I think my paper is a starting point to this, but for the US,
you're Mexico borrowing in dollars, so the option to inflate away your debt,
it's not there.
So
Exactly.
We'd have to think about that.
So I am thinking about it, and I view it as my research agenda going on.
And you'd also have to think about tax smoothing, not just international.
Absolutely. So you have to think about the borrowing from domestic residents. You have to think about defaults through inflation more likely than outright defaults on bonds. You also have to think about market power of the US.
So the US could borrow in a foreign currency.
It could, but it just doesn't. And I think it makes sense for it to. Although the UK actually, beyond debt denominated in pound, it also borrows a little bit in US dollars and euro.
What were Brady bonds? Yeah, Brady bonds.
Yeah. They were in dollars.
Okay.
Other than that, I'm very grateful for your comments. Thanks a lot for coming, and thank you for this whole amazing year over here.
Okay, thank you.
Thank you.